Good afternoon, everyone. Join us for our Prop Funders community webinar. This is the February webinar, so delighted you could join us. And if you are watching the recording or listening to the recording, out walking the dog or in the gym, pounding out the miles, then hope you enjoy our monthly community Prop Funders webinar. So I've got three fantastic guests, which I'll let them say a quick hello now. You can just maybe just give a name and maybe where you are today. Probably a good way to start, and then you get the formal introductions in a few minutes. But I'll let you each of you say hello.
Fine. Stefan Canavan, owner and CEO of Willow Isle Capital, financial brokerage based in London.
Julianne,
Hi,
you're next. Or
yeah,
whoever.
sorry, Julianne, you go next.
Thanks, Rory. Sorry. My name's Julianne White, and I have a couple of different companies. I'm here obviously today to talk about funding, so we'll stick with that one. And I am in Drizzly, Northern Ireland today.
Hello, so my name is Rory O'Mara, CEO and founder of Close Bridging Finance. We started up about 20 years ago, and we do two things. We lend our own money and we broker, basically help you get your deals funded.
Fantastic. Everyone's very polite there, very quiet and polite. Hopefully we get a bit more jumping in when it comes to the controversial and contentious what is the best source of funding when we get into that, but we'll come there. So again, welcome everyone who's joined us. Really appreciate everyone taking the time to come here today. Just get down to the next slide. We had as usual, you have an IT check and then it decides sometimes to play up, but there we go. So just to remind everyone that prop funders and what we actually do. So our mission statement has evolved slightly from what it was in 2024. So our mission now is very much to save property developers and investors time and money by structuring, sourcing, and simplifying property funding. So very much around that, helping developers structure, helping them source the funds, helping them simplify the property funding process. And today is going to be a brilliant webinar because we're going to be focusing on the different sources of funding, which I think is a great way as we move on to the year. So yeah, into 2025, no doubt for many of you, you're now right in the middle of a new year. You've done all your planning, done all your strategizing, but no doubt for many that I've been communicating with, there still is this need to source the right funding. There still is the requirement to make the capital stack work, and that remains for many developers the biggest bugbear, the biggest pain point is sourcing the funding, and that's why today is all about hopefully helping you navigate that process, and obviously introducing three professionals to you that may be able to help you if you have a particular need. Had a phenomenal 2024. When you look back at the end of a year, sometimes you forget just everything you've managed to do and everywhere you've been during the year. So looking forward to the end of this year, putting up a new slide with everything we've done in this incoming year. So absolutely delighted today, say to have three property professionals. I've known each of these people for many years, and delighted to be able to spend some time with us today. So what we're going to do is they're going to introduce themselves a little bit more formally. However, I've asked Stefan to go first because I've also asked Stefan to do a market update. He's done this for me a number of times over the years on webinars, and he does a really good sort of whole of the market analysis. And I know that developers will find this very, very useful. So Stefan's going to introduce himself, do his market update, and then we'll hear from Rory and Julianne in terms of an introduction, and then we'll get into our panel discussion. So Stefan, over to you.
Yeah, great. Thank you very much, David. You've got the slide, so I think we can skip on to the next one. I won't spend too long talking about us, but I'm the owner and CEO of Willow Isle. My background was in the city as a strategy consultant, and then I also developed for 8 years. So personally, I've built around 60 to 80 units. Willow Isle is split into two fundamental sections: Willow Isle Capital, which covers everything that's unregulated, so bridging, refurbishment, development equity, stretch senior, MES, all of that fun. And we were shortlisted as one of the top 7 bridging brokers in the country last year by the NACFB. Unfortunately, we didn't win, but you've always got to push for something else next year. And then we have the mortgage side, which is the regulated side. So that covers all of your residential mortgages, buy-to-let mortgages, product transfers, HMOs, etc. So fundamentally, whatever you need property finance for, we can typically cover you. And my personal specialty is in doing refurbishment, dev, equity, that space. And then I've got a team who work with me on the other aspects. I think that's probably enough on that one, David. Don't want to bore people. What makes us different? I mean, Rory will know this as a broker. Often it can be quite difficult in a world of brokers, but I'd say what really sets us apart is my background's in the city and as a developer. So we have borrowed the money, we have built the sites, we have made the mistakes, so we can truly appreciate it from a developer's standpoint. And therefore, when we are reviewing your deals and working you through cases, we know exactly what is required. Going out and getting terms is only part of what a broker's job is. I mean, we've got over 150 lenders on our panel, all of which have multiple different products. And therefore, the art of what we do is really understanding your situation and matching you with the right lending options. And that is more of a skill. We don't charge broker fees. I don't agree with charging broker fees on top of brokers being paid from lenders. So that's something we try and stick to. And then we support everyone throughout the whole life cycle of a case. So that's not just getting you terms, that's through valuation, through monitoring, surveying, through legals. We've got full-time case managers, and then post-completion into drawdowns, management, and then exit. So hopefully you get a fully rounded service from us. I think that's enough there, David. If anyone's got any questions, feel free to get in touch. So David's asked me to do just a brief financial update for you. So I've tried to condense a lot of this into one slide, but I do a bit of talking around it. And apologies, because I sent these slides to David late last night and the inflation data has just been released today. So I did caveat the inflation point on the slide before I sent them to him. So it won't have escaped anyone's knowledge that base rate was reduced from 4.75 to 4.5%, with a strong vote from the MPC of 7-2. That was very promising to see and was likely driven off the back of strong inflation figures in January. When we were at 2.5%, the inflation figures have been released now, and it has jumped to 3% from 2.5%. Now, I personally would say that's not a surprise. I think the bigger surprise was when it reduced to 2.5% when we were at 2.6%. I think most people thought it was going to increase then. The 2.5 was a bit of a surprise. The Bank of England have openly come out and said that they thought it could rise to 3% this year. The EY Item Club have said potentially up to 3.7. The target for the Bank of England is 2%. I would say in and around the 3% mark, we shouldn't be too concerned. I think at the moment that's where the Bank of England are expecting it to be. I think if it continues to increase from there and hits that 3.7 or above, then maybe we need to start reconsidering and just being a little bit more cautious. Fundamentally, the Bank of England have quite a difficult job at the moment. You may have heard a phrase called stagflation a lot in the press at the moment, which is an economic term that fundamentally it's defined as 3 things happening at once. It's stagnant economic growth, high inflation, and high unemployment. Now, our economic growth figures have been poor. We're at kind of 0.1%. The Bank of England reduced our forecast down from 1.5% to 0.75%. Inflation is on the rise, and whilst unemployment is okay, the changes in the budget to national insurance may have an impact on that. So the Bank of England have got an interesting job at the moment to try and balance stimulating the economy for growth, which for the most part, their main tool is to reduce interest rates, but also trying to keep inflation under control, which for the most part, what they try and do then is raise interest rates. So over the next few months, it'll be interesting to see how they manage that. Finally, if we look at swap rates, so if you're not aware, swap rates are, in its most simplistic term, what banks lend money to each other for. And contrary to popular belief, it is not just base rate that defines what mortgage rates are set at. Swap rates have a much more fundamental impact on that. So if you want to understand what's happening with mortgage rates, you look more towards swap rates. The first part of the year up to about mid-January, swap rates were on the increase. But over the last 2 to 3 weeks, they have been gradually decreasing, which has then led to a number of mortgage lenders reducing their rates across the market. So hopefully that trend continues, but it will be heavily dependent on both the inflation data as we get more of it, and what the Bank of England does with base rates. Just a couple of things for you to note. The next MPC meeting, that's the Bank of England's Monetary Policy Committee, is on the 20th of March, and the budget at the moment is forecasted around the 26th of March. So that will be an interesting update from the government. David, if we go on to the next slide.
Okay. There's the play ball. There we go.
All right, so I'm just going to do just really quickly roughly where rates are at the moment across different product types. Sorry, David, the slide before.
Yeah.
So on bridging, a large share of what we do is residential bridging. So that includes house purchases, flat purchases, auction purchases, development exits. Best rates for that at the moment are at about 0.75 at 75% loan to value. If you're doing a lot of auction purchases, there's an AVM product that negates the need for a valuation at 0.79. And if you're doing refurbishment works to properties, then there are lenders who will lend more than 75% of the value up to 90% of the purchase price, and they're priced from about 0.79%. That 0.79% product at 90% of purchase and that AVM product are probably two of our most popular at the moment. Refurbishment loans, which is where you get a percentage of the purchase price plus the works funded in arrears, are priced from about 0.77% is probably the cheapest. I'd say most are being placed at about 0.8 to 0.9, and the lenders are willing to give you up to 75% of the purchase price, plus all of the works funded in arrears. And then on the larger development loans, the cheapest in the market is probably 8.5%, but that's more exclusively for deals above 5 million. That being said, though, and actually this slide is maybe just slightly out of date, the dev loans more from 500,000 to 1 million and above, we are now getting rates at 9.2, 9.5, 9.7 in that type of region. And it has been quite a long time since we've seen rates in that 9% bracket, which is really positive. Most dev lenders will consider going up to 65, 70% of GDV, 85 to 90% loan to cost. But we do also work on more bespoke products, things like stretch senior, stretch mezz and equity, which can go up to 100% of the funding for a deal. Might get onto it later, but it's probably worth noting that I think this has probably been the most competitive start to a year for lenders in terms of rates, how much they're contacting people, product diversity. We are doing a lot of bespoke pricing at the moment that is completely off book because lenders are quite keen to win certain deals. So there is a lot of activity out there in that bridging and development market.
Brilliant.
David,
Okay.
if we just go on to the buy to let and resi.
Yeah, if we just do a quick overview of this, maybe, and then we can send it out. But it would be good.
So this is more of a take a photo of it and refer back to it later. I don't have the time to go through this. Fundamentally, what this does is it breaks out most of the best rates on the buy to let and resi products at the moment. The red is where we were last month. The black is where we were as of Monday this week. So as swap rates have come down, the rates have come down slightly, but maybe not as much as we would have hoped. And when you look at it, a lot of the big stuff that makes the press, you might have seen, you know, suddenly sub 4% mortgages. Technically, that's correct, but it's only at the 60% loan to value, lower geared primary residence, the general buy-to-let and HMO market where a lot of our clients are playing is priced higher than that. But any questions on that, give us a shout. I'll probably stop there, David, and then I assume we'll cover a lot else later.
Yeah, no, absolutely brilliant. No, I thought that was really useful to go through just a high level of where we are. We'll probably answer some questions that some people may have asked. So remind attendees, you're welcome to put questions into the Q&A. Don't put it into the chat box, into the Q&A, and we can potentially deal with them sort of live now as we go through, or we can do follow-up and make sure you get your questions answered. But by all means, as Stefan said, take a screenshot of that now. I'm happy to send out the slides if anyone wants to afterwards as well. So thank you for that. So I'll just very quickly take a screenshot of that if you want for Stefan's details. I'll give you 10 seconds before going on to Rory. Okay, and if each of the panelists want, just type in your email address into the chat box if you want, and then people can have it there as well if you want. So, okay, Roy, over to you just for an introduction, and then we'll be do Julianne in the discussion. So, over to you. You're currently on mute.
Here we go. Yeah, so my name's Rory O'Mara. I set up Closed Bridging Finance about 20 years ago. So those of you who remember, in the good old days, you could buy property in the morning for cash and refinance it probably an hour or two later with a company called Mortgage Express, and that was known as a daylight bridge or a closed bridge. And that's literally how we got into lending money. Now, obviously, things changed a lot when those products got pulled, and then we had to change our model to lending for much longer terms, which was quite interesting way back in the day. So most of what we've done is really just working with clients who've got properties that they buy where they add value. We've funded lots of 3-bed to 5-bed, 3-bed to 6-bed HMOs, which is probably the biggest part of the market, I think, that we've funded. Commercial to resi, you name it, we've probably done it. But yeah, if you want my contact details, they're here. Big part of what we do is very simple. It's all based around strategy. If we get your strategy right, and that's where I help clients. So that's something that if you're struggling with what you're doing, you can book a call or even come and see me in sunny Winchester. And there are the contact details there. Thanks,
no problem. So yeah, there's different bookings. So the top one is just for your strategy review. Someone will actually sit down. Is that a face-to-face 4 hours, I'm assuming?
That is yeah. If you no, it is. No, that's right. That's face-to-face. But most people just use that tinyurl.com and you access my diary and just pick my brains.
Yeah, no, absolutely. So they can book an initial one and then a more detailed one if that's required. Fantastic. Okay, brilliant. And Julianne?
Hello. First of all, how long do I have so I can know what I'm going to say really quickly?
I will listen to that intro, just sort of 2-3 minutes for this sort of intro.
Okay, right. I'll try and keep it to that. My name's Julianne White. I have been working in the property industry for probably about 10 years now. However, different to Rory and Stefan, maybe in some ways, in terms of I am a surveyor by trade. So that is where I started working in the property market. I am more recent to the finance side of things for a company called Plutos Associates. However, Plutos Associates have been in business since 2012 and did start off as a broker as well, a boutique type broker. But now we are a lender and I am a partner with Plutos. So yes, it's really interesting to hear Stefan and Rory and stuff as well, and everything to do with mainland UK. And I know this is where this webinar is mainly based, but mainland UK have things so easy compared to Northern Ireland. Like, it is scary. But yeah, it's fantastic, all the products that mainland UK have in comparison to here, but I am hoping that is going to change very slowly but surely. So yeah, like we work all over. Plutos Associates lend all over mainland UK and in Northern Ireland now too. I have a bit of exclusive information, but I'm going to release that next week, unfortunately, so I can't say it right now. But yes, I say they've been in business for since 2012 and have created so many good relationships between the borrowers and introducers and everything over the past number of years, and have a really high reputation for speed as a direct lender in the industry.
Absolutely fantastic. And I thought that was the best way of doing this so that people on the watching in have a better feel for who the three panelists are, and get a better feel for where they're coming from on this. So here's the kind of the discussion points we're going to go through. What are the different types of funding available? What is the capital stack? What is a typical LTV if it's applicable on the loan side? How much do developers need to put in? The benefits of using a broker versus going direct, and then what are the risks with different types of funding. So that's kind of what we'll work through. I think before I come off the screen, we'll just maybe talk through this. Let's see, Julianne, do you want to go first on this, and we'll sort of reverse order, just maybe make a sort of a 1 minute comment on the capital stack and what importance that plays in a developer looking at funding.
Yeah, I suppose what I was just going to say on that is in terms of a lending point of view as well. I know for us, definitely in Plutos, whenever someone's coming to us looking for money, we want to see that person has serious skin in the game. We are only interested in senior debt for first charges. That's all we're interested in. So we don't do anything else apart from that. Although I do obviously think it has to be so important if you're using anything else like mezzanine debt or anything else. It has to be so well structured. I think Rory had alluded to this slightly a little while ago in terms of having the right plan and strategy in place for whatever it is you're going for. So I suppose I know Rory had mentioned he does calls to put maybe capital stacks together. I know you do that too, David, as well. So I think it's really important to have the whole strategy, no matter what way you're gonna line it up. It has to be all exactly right, and you have to know what your end point is and what is the best way to get there, and what is the cheapest way to get there, probably as well is handy.
I mean, interestingly, as a broker, probably the most common question you're asked is, how can I put in as little money as possible into this deal? Right. That is often the most common question a broker is asked. And it's our job, looking at the capital stack and what each of the lenders will offer, to calculate that for clients. And that might be through a combination of senior, stretch senior, mezz, or equity. There's a number of different ways to get there. But it's interesting from a lender's point of view, they're like, we want you to have as much in as possible. From a client's point of view, they want to have as little in as possible. And it's that balancing act, isn't it?
Yeah,
Yes.
no, that's a really good point. So Rory, when you're sitting down and you mentioned you're strategizing there, what are you looking for in a capital stack? What makes a perfect capital stack in your world?
Sure. So can I just go back a step for the benefit of the people listening to this? Because some people have no idea what the capital stack is. Yeah.
Yep,
It's like,
definitely.
what are you talking about? Because they could be new. And that is essentially everything that you're seeing in red is the money that you're going to borrow. It's essentially a loan. The stuff that you're seeing in green, which is the equity, in theory, that's your money, your cash that you put into the deal or someone else's. And then what I'm looking at is, well, the first thing is, well, who are you? What's your track record and your experience? Do you know what you're doing? Then what's the deal? So let's just understand the project. It might be something very simple. 3-bed to 6-bed HMO. Are you going to keep it or are you going to refinance it? And in this market, we have projects that we have funded or where we've arranged aspects of the capital stack where it's proved to be really difficult to flip because it's not really a seller's market, depending on where you are. So we're just trying to get an understanding of that when we're sitting down with the client. What's the deal? How are you going to get out of the deal? And do the numbers make sense?
Yeah, no, that all is really good, and yeah, you're right that for some people they maybe don't see it as a holistic approach. I think one of the things I've seen happen over the years is where people go off and look for their lender without any thought for what are the choices for the actual capital stack in terms of the equity side, and then after, and I think Stefan, we've bumped into this a few times, after they've got their senior debt in place. Then they go maybe look for crowdfunding as an example, to only be told that the lender doesn't allow multiple sort of passive investors into the deal, and then
Yeah,
you're
well,
left with this sort of dichotomy.
when you start playing in how does the equity versus senior play into each other, you've got to be careful because certain lenders want a certain amount of skin in the game from the client. Only certain lenders will allow second charges, which is what mezzanine finance and often investors may want. If you are using mezz, certain senior lenders will only work with certain mezz funders. Most mezz funders won't sit on top of peer-to-peer lenders. So it becomes quite a puzzle to piece together, and you can't look at everything separately and then hope it's all just going to come together at the end. You have to start with the end in mind and then piece everything together on the way as you go through.
Yeah. Now, before I sort of come off this slide, I think this slide very accurately depicts the kind of risk on one side and then the return on investment on the other. So Rory, as you alluded to, the red at the bottom is going to be debt. It tends to be a first or second charge of an asset. I tend to say that the senior tends to be single digit, but then on the left-hand side, priority and default is obviously the strongest. And as you work up to the very top of the capital stack, if someone's putting in equity, then there's no security. So the priority and default is the weakest, but the potential return on investment is actually a lot higher. How would each of you have that conversation with a developer around that balance in terms of risk of a project going wrong and what might happen versus reward being offered to investors?
I think I might just start with that. I think Rory had said this earlier too. Like one of the first things that you're going to do whenever you have someone, obviously a developer or an investor looking for money, is their experience. You know, what experience has that person got? Because, for example, if you're going into something that's a bit more high risk and you have never had any experience in developing or investing properly before, probably don't do it, you know, unless you've got a strong team around you that can guide you. So I think as well, a lot of this and a lot of the risk is to do with experience as well. Obviously, I think Stefan has said as well, he's obviously a developer himself, so he understands what it's like to develop and he knows what can go wrong and he knows how to get around it now and how to have a solution for it. Whereas if you're just starting from scratch and you've got no experience, I would say avoid higher risk strategies and stick to something that is going to have less potential pitfalls for a start.
Couldn't agree more.
Yep, no, I agree. And I think a good example of that would be I had a conversation with a client last week who'd been on a property course. I said, just take me through the deal, take me through the numbers. And actually, when you worked out the margin on GDV, it was about 6%. And I went, that's not a deal. I went, you know, and then we got into the detail behind the end values, the gross development value. He said, so do you have, you know, for what you're looking to flip, which is also, I think, tricky in this market, you know, to flip a house that might be worth 600,000. How many recent sold comparables have you got? And I mean recent. And the client said, oh, there's one for sale. In my world, that's not a comparable. That's a wish. And if you worked out, I think when we looked at the margin, I think it was about 6% margin on GDV. You know, you're in for a hell of a lot of borrowed money, and you might make £30,000. It's not a deal I would touch. And to be fair, we spent about an hour just talking through how you fund these deals, understanding the capital stack, and just getting your head around some of the basic maths behind margin on GDV and what sort of profit you should get and where your risk would be. And I think the big risk today is understanding end values. Is your GDV realistic? Because if it's not, you know, that's where coupled with some extra costs, maybe for conversion or development, you could lose money very, very easily.
Yeah. I mean, on development loans, most lenders' minimum funding criteria is 15% profit on cost post finance, because they are then trying to mitigate for any downturn in the market or upturn in build costs to make sure that the client can still get out okay. Once you start to drop below that, as Rory said, the deal ceases to start to become fundable. Because it's just too tight on a flip. When you're refinancing, there's a bit more flex if you are looking at, you know, HMO deals, because a lot of people appreciate that you're not just doing HMOs, that you're refinancing for paper profit. You know, you're doing it for long-term cash flows. So there's a little bit more flex there. But on buy to sell schemes, you've got to make sure you've got the margin to make money and also to absorb any issues that might come along the way. Because no, I don't think any property project has ever finished on time and on budget.
No, that's a very fair point, actually, Stefan. That's probably the main point I raise when I speak with clients. And I've been lending my money for 20 years. I don't think a project has ever come in on time, on budget, because it's just something that you find in terms of build cost or whatever it might be. Yeah.
Okay, so we'll do the next sort of 15 minutes or so like this, so it's easier for people to see. I'll probably even go to whoever's speaking on top of the screen. Even perfect, even better. Okay, so LTV. So a developer comes to you and says, "Look, I'm not sure how much equity I can get my hands on. Equities may be tight. How's the conversation regarding LTV go? What is the realistic expectation of an LTV regarding lending?"
I think you need to start understanding whether you're talking bridging, refurbishment, or development first. The loan to values vary across product types. Any good broker should be able to, and we do this for every client on every deal, is we will run a full debt review for that deal, breaking out what the debt profile of the different loans can look like, roughly how much cash is there needed, and what that is priced at. But yeah, the loan to values that are available across different products types change.
So Rory, one for you then on this. So a developer comes and there's potentially two different sources of funding that might work on the project. Sometimes a bridge works, sometimes you can maybe go straight for commercial development finance. How often does a developer just say, which one is cheaper and I'll go for that one, as opposed to actually understanding what is the better product? So I suppose another way of asking that is, do developers spend long enough asking for the best product, or are they just fixated on the cost of money?
I think people are focused on, generally, if you're inexperienced, it's like, what's the rate? And it's never about the rate. The rate's important. It's about getting the deal funded. So my approach is always, I keep everything very, very simple. What's the deal? Just explain it to me. So it might be where it's bridging, as in, we just need some money. Say I'm buying a 3-bed house, I want to refurb it. So really, really simple. And let's say you're going to you'll refinance it. You know, a bridging loan, as Stefan said, you might get 75% gross loan to value. But again, I think one of the important things to factor in there would be, I would never recommend a 6-month bridge. I've seen people take out 6-month bridging loans, and boy, I've seen someone get into real trouble with
No, we wouldn't either. We wouldn't either.
I say, look, we go for 12. You pay for what you eat, and depending on what you're trying to achieve, 12 months should give. If this, I'm talking about a simple bridge, say on a refurb, really, bad, 3-bed house in bad condition, you might turn it around, say in 3 to 4 months. You've got some time there to sort yourself out. So that will be priced at whatever it is. There's no shortage of lenders if I have my broker cap on. But if you're talking about development, so in my head, it'd be interesting to speak to the panel. Development finance to me is normally ground up. So I've got a couple of projects that we're involved in where I've arranged, I just didn't have enough money because we were in other projects. So I arranged the senior debt with other lenders. I've done the mezz funding and a profit share. So my view on everything is I just start with a blank sheet. What is it? Okay, how can that work? The most important thing from the client's point of view, so when I spoke to someone, a solicitor rang me about 6 months ago. He had a client who basically found a broker who managed to find him a 6-month bridge to buy some land. I have no idea why he bought this land. And I said, what's your problem? He said, well, I can't get the development finance. I said, well, why was this not arranged at the start? Because the site had planning. Anyway, a very long story short, his build cost was £98 a square foot. I said, you can't build at £98 a square foot. He said, I can. I said, well, you might be able to, but you're not factoring any margin for yourself, but it's not realistic. And funny enough, the broker in question couldn't find a lender. The problem is he bought that land at auction with a 6-month bridge. He had no money. So this is why I think you must have skin in the game, because the skin in the game, guess what, was the second charge on his main res.
Ooh.
Which when we went through the deal, I said, right, let's just be very clear. The 6 houses you're looking to build, I said, I wouldn't touch it. I don't know. And I'll take look at a little bit more risk from time to time. But I said, I don't know how you'll do this. Meanwhile, the bridging lender, because it was a 6-month loan, were demanding to get paid. And I said, you now need to, relook at your main res. Can you refinance, or you may have to sell? Now, that's why when you look at the capital stack and you load everything up, was that such a good idea? The broker, and I will put this down to the broker, should have understood the deal right at the outset and went, look, £98 a square foot for build cost. I don't think that's going to wash.
There's that, Rory. There's another thing that we do on all deals, and it's another thing that people can get caught out on, is when you take out a bridge for a development site, a lot of people don't factor in that a bridging lender will simply lend against the value of the site.
Yes.
But development lenders don't do that. Development lenders lend against loan to cost and loan to GDV. So there's no guarantee that your development loan will be enough to clear the bridge once planning is in place, unless you've ran the numbers on the full cycle of the deal. And we've had a lot of clients come to us and say, well, we've got a bridge outstanding on this. Now we want to go on to a dev loan. When we run the numbers on the dev loan, they go, but hang on, that's not enough to clear my bridge. And we're like, well, that math should have been done before you took the bridge out. And that we do that. We call it kind of like the bridge to refurb calculations or bridge to dev calculations.
Yeah.
When you're taking out a bridge, you've got to make sure that your dev loan can clear it, or that you've got a plan to raise the equity at the point in switching across to the dev loan. And it's a big trap that a lot of slightly more inexperienced developers fall into.
Yeah. And one way, sorry, just to add to that, I would always suggest, if you can, is it possible to maybe use an option contract or something to at least acquire the site with planning? So therefore, you're not having to use a bridging loan to hope and pray that you may get planning. I think it's very, very risky doing that. We've done a few in the past where we've been pretty certain that we understood the local development plan, and to be fair, they've worked out. But I know other clients where they've taken investor money and they're sat there for 12, 14, 18 months and they're still hoping and praying they get planning. So again, you just want to try and mitigate your risk, don't you? And you certainly don't want to be on a bridging loan, certainly not a short-term bridging loan.
Yeah. So Julianne, I'm going to just pivot this slightly. I'm going to come to you now. So just to confirm what Stefan said, so important, and that was around understanding what is the criteria around the lender. And even a lender might have different criteria for different products, even though it's the same lender. So that is a very, very important part. So if you want to comment on that, Julianne, but then want to go on to which was mentioned about skin in the game. So and obviously you're someone who kind of lends your own money in terms of where you're involved. So what would the expectation be of what skin the developers bringing to the table?
Well, I think what Stefan was saying there, sorry, as well, is just all about experience. Like what Rory was saying there as well, it's all about experience. Somebody new into development is not going to know all those things. They're maybe going to jump in without the appropriate information unless they have a team of people who can guide them. That's always what happens. And do you know what? Sometimes you only learn by making mistakes as well, to be fair, provided it's not too fatal, then you'll be okay. But yeah, skin in the game is so important, because what we have kind of found is, and you know yourself as well, if it's you, say for example, I have a property deal that I want to buy, I want to sort it out myself. If I am using any of my own money, I am going to be more inclined to try and do my homework and do my research and make sure it's fine, because it's your own money. Does that make sense? Even though this other money that you're borrowing is essentially yours too, the source of it isn't coming from you. So it's almost like there's more of an onus, and it makes lenders more comfortable whenever you're putting in your own money, because it's money you've worked hard for that you're putting in. So it's your way of saying, I think this deal is going to work. This is my experience. This is what I've done before. This is the success I've had before. So obviously I know what I'm doing. Please give me the money. This is what my strategy is going to be. But the main things are as well as skin in the game is having a clear pathway to what it is you're trying to do. How are you going to exit this? What is your exit strategy? And if for whatever reason you can't do plan A, what is your plan B? You need to have all these things tied down. And that is from experience again, and from surrounding yourself with people who know things that you don't know, so they can keep you right. So I think nowadays, you know, as well, same in mainland UK as it is over in Northern Ireland, there's so many property courses out there being taught, or whatever you would say there, and you know what, they just aren't teaching people the fundamental things that they need. It's more for gaining money quickly from people and then letting them fly off and do whatever they want. And a lot of the things you have to make sure whatever it is that you're being told is credible, it is true, and it is going to work in your area. Because as Rory was saying there as well, like, even in Belfast, for example, one street across from another can be completely different in terms of what sort of strategy would work, what cost is going to be involved, what the GDV is going to be, so you really have to know your area as well. And even Rory, you're saying there as well about studying development plans and stuff as well. Even planners can be an absolute nightmare. And even if you've looked at the development plan and everything else, you're never 100% guaranteed that anything's going to work. So I am a big fan of option agreements, actually massively so you're not wasting any unnecessary money as well.
No, that's a really good point. Okay, so there's a couple of questions have come in, which we'll do the questions at the end, about 5 minutes or so. We'll start to wrap up, but what definitely want to get on to, and it really just is effectively what Julianne was saying and what Rory and Stefan have alluded to around the whole piece of experience versus looking at a deal properly, which leads on to the question about brokers. So some developers would always go to a broker. And others think, I want to save money. I don't want to pay a broker fee. I'll try and go straight to a lender. So we'll go sort of one main sort of pro of going to a broker. We'll sort of give everyone like 1 minute each on that, and then if anyone's willing to say what are some of the cons of going to a broker. So Rory, we'll go with you first, then to Stefan, then to Julianne. So what's one of the main advantages of going to a broker?
Well, we're in an interesting position because I'm a lender and a broker. And so client will come and have a conversation with me. So just explain the deal. It might be where it's what I call, let's say it's a bridging loan. Just keep it simple. If it's plain vanilla, we'll broker that because I can't compete with some of the lenders out there, and I don't try and compete on price. So if I can get you the right product, we would broker that all day long. We're going to do the heavy lifting. We understand who to speak to. We know how to speak to the underwriters. And it might be something maybe about you might be inexperienced. I've got a project we're in right now with a client who he's one of my clients. I've funded 2 of his deals, but you might deem him to be inexperienced. But I've managed to convince the lender, look, he knows what he's doing. What was the problem? He had a fixed price build cost on a JCT contract at £148 a square foot. Now I know the contractor can do that, but the lender was like, that's low. If you've got a good broker who knows what they're doing, they can have that conversation. So okay. I think it's the time and place to do that.
Brilliant. Stefan, as a broker, no doubt you're going to be very pro broker.
I am, but there's a whole host of reasons why. I mean, on our books, we have over 150 lenders, all with different product types, all with different requirements. I mean, developers have 3 jobs: find sites, build sites, find money. They don't need to be understanding what 150 lenders are doing. That's our job. Often people think it's more expensive to use a broker. I'd argue it often works out cheaper. So when clients often go direct to lenders, they still get charged the full arrangement fee, which is what they pay us out of. We also, as brokers, can negotiate more because we're doing 30, 40 deals a year with a lender rather than just one. And lenders would rather do 30, 40 deals with a broker than a one-off deal with a client. And fundamentally, we're there to try and find the optimal debt solution, which overall should save money, but also spot, and like we've been talking about here, all of the pitfalls, or as many of the pitfalls that could arise as you go through the process. You don't know what you don't know. I mean, it's like it changes slightly once you are far more experienced, and you've done, multiple development loans and multiple bridging loans, and you're fully aware of all of the process. Then by all means, I mean, there are clients who go out and do it on their own, but then they're not aware of how the market is moving. I mean, if you look at the market this year versus last year, it's, the best lenders are completely different to where they were this time last year. So it's important to have someone who stays on top of that.
Okay, well put. So Julianne, I'll let you kind of play devil's advocate then. Broker or direct lender?
Well, I mean, very like Rory, obviously, even though that we're a direct lender, we do broker stuff that isn't for our appetite as well, so obviously there's pros and cons for all of these things. However, I mean, the main thing for a broker is exactly as Stefan has said there, you have a pool of people you can go to rather than obviously the direct lender is the lender who is one person. Are we just talking about brokers now? Is that all we're saying just now?
No, well, or else you make the argument for a direct lender quickly then.
Okay, I will say
Why
quickly.
should I come to you rather than going to your broker?
Well, a direct lender is just that the decision process is much, much quicker because you're dealing with the source of the lending rather than a middle person. Not that I have anything against brokers whatsoever. There's excellent brokers out there who are worth their weight in gold, obviously. But in terms of just as a direct lender, you've got speed and you've got accuracy and you're the one lending the money. So you're confident in the deal from the word go and it just makes things so much quicker, I think.
I think that's a very good point. Okay, so the last thing then we're going to discuss, then I've got some questions, and I'll probably pick the best one, then we'll move to wrap up. But very often developers, and I've discovered this through my journey with crowdfunding, and the market changing with interest rates, inflation, development costs, and all of a sudden deals that looked absolutely wonderful on a spreadsheet. As I think Stefan said at the very start, he's never seen a deal come in on price and on time yet. So developers very often have the starry eyes of everything's going to go great and how wonderful they are, and then there's the reality of what actually happens. So what are some of the risks involved in lending, in terms of what should developers be aware of when they tie themselves into, I think maybe particularly a bridge tends to be a wee bit more teeth to it straight away if you hit the end of the term, but what should developers be aware in terms of the risk?
Should I can start. I mean, Rory made a very good point, which we completely agree with. Always make sure you have long enough on your term facility. Do not take something that is too short. I agree with Rory. We've had clients say, look, we'll be in and out in 6 months. Great, you may well be, but please still take 12 months. If you don't use the interest, you don't pay for it. So there's no need to be risking going into default. The risks the clients need to be aware of are if they do go over term, there are typically default rates and default charges. For the most part, most lenders will discuss extensions if there's a genuine reason why, and that's put forward sensibly. So there can be some mitigation there. But the biggest one that everyone has to appreciate is that with all of these loans, you are putting forward personal guarantees. So there is a personal guarantee that sits behind it that if, for any reason the lenders can't recover their money, then technically you would need to fill any void with a balance from your personal assets. And as Rory said, I mean, some people will put charges and things on things like main residences, which you probably want to avoid. But yeah, the personal guarantee is probably the biggest risk, and people need to be aware of that.
Yeah, good point, Rory.
Yeah, I think the key thing is, look, if whether it's a bridging loan to do, say, a refurb or something simple or something more complex, you need contingency. You need maybe 10, 15% if you go back through COVID times when costs escalated, way beyond anything that you may even have in a spreadsheet. So I think, you need to make sure you've got just some extra buffer there to cover some extra costs. And overall, just looking at the whole deal, I think in this market, the GDV, your gross development value, i.e. the end value that you're expecting, whether it could be flats or whatever it might be, where did you get the data from? And often, so for example, if you're looking at a comparable, an agent might give you today, or it appears through the data from Land Registry, just be mindful that deal was probably negotiated 6 months ago. It wasn't last week. And where was the market at that moment in time? So I think, and also, for example, we did one, we funded a hotel into flats, but the client decided to sell to keep the rest of it. It was a multi-unit freehold block. Well, he didn't use us to do the exit. He went to a broker because they were cheap. What the broker didn't tell him, a multi-unit freehold block valuation, the valuer chipped 15% off the value because he didn't extract the value by splitting title, which is what he should have done. And that was the conversation we had right at the start of the project. But he wanted to save some money. So in saving some money, actually, it may not have worked out in his best interest. And it took nearly 6 to 7 months for the term lender to pull the money down.
Yeah, yeah.
Just took forever. I don't know why, because we weren't involved in doing the refinance. And so again, really clear on your exit. Just understand you need 1 or 2 and maybe even 3 routes for exit. One of his exits actually put it in an auction because he literally was pulling his hair out because our bill was racking up on the bridge.
Yeah,
And it was outside of our control. I gave him a tip that basically enabled him to get his money within 2 days. But I can't say on screen what I told him. He got the money quickly.
We'll have to have a private VIP.
You have to book a one-to-one to
this.
find out what that was.
Yeah, no, brilliant.
Well,
Julianne, go ahead then in terms of risk for developers.
Yeah, just to add to that as well, as you had said earlier, David, as well, and I think we've all said it too, cheapest isn't necessarily best. Relationship with the lender, how understanding that lender is. Like I know in our experience in the brokering side of things, like goodness me, we, would have dealt with some awful lenders, who were just really rigid and that was it. You have to really, I'm all about relationships and anything, regardless if it's property or whatever. Everything is about relationships. The better communication relationship you have with a lender, with a broker, whatever, the faster things get done and the better the deal is. And if you need anything, should you go over whatever, you're more likely to get it than someone that you're completely cold to. So I think relationship is a big, massive thing there as well. And yes, there's always things that happen that you're not accounting for. For example, a refurb project, one we do a lot, as you know, David, a lot of refurbs ourselves, and one that we got recently had a lot of dry rot hidden, and that was a cost. There's stuff like that you just don't know until you start into. So it's always good to have a buffer, definitely at least 15%, I think, as well, because you just don't know. Could the market change and then you're stuck? You just don't know. So you have to account for every possible thing that you can, and a buffer is a way to do that as the best way possible.
No, I agree fully. I think I often say property development is not for the faint-hearted. You have to be aware of everything that's going on. Okay, I'm going to give each of you sort of like a 20-second wrap up. I've just a couple of slides here to do first, and then we're ending where we are. So if I can just move the slides on a bit. For some reason, my computer's been very temperamental today. I don't know if it's blaming the weather or what we're blaming, but yeah, within prop funders, we have actually done a number of projects, some are quite complicated. This was a second charge private loan because a lender had changed their rates at the last minute and there was a shortfall in the capital stack. We have been involved in sending clients through a broker to one of the main bridging lenders in Glenhawk. And we've also been involved in crowdfunding. We've been helping developers prepare and launch on a crowdfunding platform, which enables them to get access to property or retail investors, as opposed to just high net worth and sophisticated. So again, another interesting route for those that perhaps want to build an investor tribe. But within prop funders, we have helped developers do all of those. For those that aren't aware, if you go to our property funding podcast, we've got a whole bunch of great episodes there. The next one has either just launched or will probably launch tomorrow with Lorraine Thomas. I know there's a lot of expectation of people waiting for this one to come out. Definitely one of the best that we've done. So watch the channel for that and make sure you have a listen into Lorraine Thomas's story. And if whoever wants to reach out and have a chat with me, there is the link on the screen. You can book a free 30 minutes and find out how we can help developers, if you like, start that journey, almost helping them prepare before they go and talk to a Stefan or a Julianne or a Rory, so that when they go and engage with the broker, then they are presenting and putting their best foot forward, if you like. So anyone wants to know what we can do to help, then reach out and give us a call. What I didn't do was that one question, but we're actually running out of time, unfortunately. In fact, no, let me quickly do that because I know the person that asked it, and I know that it is an interesting one regarding Belfast. If I can just No, it's gone. It's gone off the screen. No, I'm afraid it's away. Apologies to the person that asked that question. I'm going to have to
David,
come back to you.
I can read it, David.
Yeah. Go ahead. Go quickly. And we'll just do it very quickly.
It's afternoon panel. I am currently looking at exit refinance options for a serviced accommodation scheme in Belfast city centre. Before entering into securing the property, embarking on the planning and carrying out the renovation, how would a refinance funder calculate the GDV? This is interesting because this would, I'm making the assumption they want to buy this property and then try and get planning. Personally, I would be very reluctant to buy a property either on a bridge or with my money and hope that I get planning. I'd want to secure it with an option, get the planning. Then once I've got the planning, obviously undertake the work. The end value, if it's serviced accommodation, the interesting thing is when a lender is lending, they're not going to lend on it being serviced accommodation from a bridge or a development finance perspective. They're going to lend on essentially the brick and mortar value, whatever that may be. Any other thoughts, Stefan?
Can I just say about Belfast, sorry, specifically, because it's one of our big areas that we operate in. See, in terms of planning at the moment for short-term lets in Belfast, I completely agree categorically. There's a couple of local councillors in Belfast at the moment that are trying their best to stop all of that, and we're dealing actually with a couple of them at the moment. So yes, absolutely what you said there. Do please, if you have not bought that property and you're thinking of buying it without the planning for that sole purpose, think again and do not buy it. Get some sort of option secured on it for sure.
Serviced accommodation specifically is very niche. There are a whole host of different factors you need to understand. The planning use class, the operating model. You need to build in a period where if you're going to self-operate, running it and improving books, it is very niche. On anything that is particularly more commercially minded, where commercial valuations are required, they are the hardest valuations to forecast. And I'm sure Rory and Julianne will be asked the question 100 times like we do, which is, how is a valuer going to value my 7, 8, 9 bedroom HMO? What yield are we going to get? And unfortunately, we can't tell you, and neither can the lender. And bricks and mortar's far easier because we can go. There's far more data available. You can look at sold comparables. Commercial valuations where a yield is in play are far more subjective. They look at supply, demand, quality of finish, type of tenant, what type of location, what type of road, a whole host of different things. So the best advice we give to clients, if they're ever unsure, undertake a private valuation. It might cost you 1 or 2 grand up front, but it could save you 10 or 20 grand down the line.
And there's some amazing, can I just say, there's some really amazing valuers that we would use on the lending side of things in Northern Ireland who would be able to do just that as well. So if you need any direction on who to use, please ask me and I can provide a couple of details over here in Belfast.
I mean, just quickly as an example, we had a client bring us a HMO and they said, look, we'll get a 10% yield because that's what their friend got in the same town. Now, the valuation came back, they got a 12% yield, which suddenly wipes 20% off of your GDV. And the reason is whilst that HMO was in the same town, it was in a completely different location, completely different type of road and completely different tenant type. So you can't just make on commercial valuations broad sweeping assumptions of yield multipliers. It is very specific.
Okay. Right, listen, we're going to have to wrap that up. Absolutely fantastic. I think that was really useful. Kind of thank Rory and Julianne and Stefan. And there'll be snippets of this appearing on social media. The full recording will be on a YouTube channel later on today or tomorrow. I tend to send out the link to everyone. I think well over 100 people are registered for this webinar. So I'll send that out as normal. So listen, can I thank all 3 of you for being on this? Absolutely fantastic. And we thank everyone for taking the time to be here, and take care, and we'll see you again. Next webinar is Wednesday the 19th of March at 1 p.m. So thanks very much, panel. Thanks very much, everyone. Talk to you all soon. Bye-bye.
Thank you, guys.
Thank you, David.